Everyone loves the idea of passive income, and in fact, the most passive form of income is dividend income. The only thing that can make dividend income even better is if you receive it on a monthly basis. I even put together an entire spreadsheet to analyze all these different stocks that are currently paying out dividends on a monthly basis, and unfortunately, many of these stocks are not stocks that I would ever want to add to my portfolio. Some of them have a share price that continues to drop, and some of them have even cut or sliced their dividend payments throughout their history. When most people buy monthly paying dividend stocks, yes, they want a high starting dividend yield, but we also want those dividends to be sustainable. We want our initial investment to grow as well. So in this video, we're going to be looking at 4 of what I believe are the best monthly paying dividend stocks. Each of these 4 stocks has a high starting dividend yield, and one even reaches as high as 12%. And if you want a free spreadsheet with a list of monthly paying dividend stocks, then you can get it at the link in the description. To analyze these stocks, we'll be using Seeking Alpha and ticker data. Now let's go ahead and dive in. The first stock that we absolutely have to mention when it comes to monthly dividend stocks is Realty Income Corporation, probably the most popular monthly paying dividend stock of all time. And I mean, if you head over to their website, they literally state that we are the monthly dividend company. This is what they want to be known for. And to be fair, they are very good at it. For example, if we look at the investor's presentation, we can see they paid monthly dividends for over 652 months in a row. And they don't just increase their dividends every single year, they actually increase their dividends every single quarter. They have 108 consecutive quarterly dividend increases. And they're also a member of the Dividend Aristocrats Index. What does that mean? They have over 25 consecutive years of dividend increases. So let's start putting this dividend into perspective. If we jump over to my stock screener and plug in stock ticker O, again, all this data will load in thanks to the help of ticker data. Now, if we come over here and look at the dividend data for Realty Income, what we can see is right now the starting dividend yield is sitting at about 5.8%. So we're talking about a high starting dividend yield. And in fact, let's go ahead and put the dividend in perspective and look at that dividend history. Again, using the ticker data function. If we come up here, what we'll do is use the ticker data function, select stock ticker O, and then type out dividend and hit enter. And what you'll see is the dividend history for Realty Income is going to automatically load into our spreadsheet. So again, we can see those monthly dividend payments don't just remain stagnant, they actually get increased on a quarterly basis. So for example, if we look at that dividend all the way back in early 2015, it's about 18.3 cents every single month per share. And if we look at the most recent dividend payment, we can see it's about 26.4 cents per share. Now, if we jump back over to our stock screener, one of the things that might have alarmed you is right here. The payout ratio is showing 291.5%. Is that a red flag? Well, we have to remember, we're talking about a real estate investment trust. Why is that relevant? Well, REITs are required by law to pay out 90% of their earnings in the form of dividends. So we don't pay attention to the earnings payout ratio in the case of REITs. Instead, we want to look at the adjusted funds from operation payout ratio, the AFFO payout ratio. So if we go over to Seeking Alpha, click on dividend safety and scroll down. Here's what we can see right here. Forward-looking AFFO payout ratio is sitting at 75%. That's pretty sustainable for most REITs. So Realty Income, a really nice starting dividend yield. They grow those dividend payments at around 3% a year, and those dividend payments also look sustainable. But here's what's also exciting. I think there's room for share price appreciation in the coming years for Realty Income. Now, one of the catalysts is going to be the interest rate environment we're operating in. REITs got hammered over the past few years because interest rates continued to climb higher and higher, making those large starting dividend yields not quite as attractive. But as we've seen, the Federal Reserve has started to lower interest rates, and they've already stated they plan on about 2 interest rate deductions in 2025, and that'll drive more people to buying into REITs, thus lifting their share price. But let's look at it from a valuation perspective. If we jump over to my REIT valuation sheet and come up here and plug in stock ticker O, here's what I want to do. If we jump over to our dividend discount model, this is valuing the stock based on how much it pays out in dividends and how much that dividend is increasing over time. We can see, assuming just a 3.25% dividend growth rate, which is in line with their average, and a discount rate of 8.5%, they're worth close to about $62 per share, while the current share price is $54.30, meaning it's around 13 to 14% undervalued at its current share price. So it should be no surprise that Realty Income is one of the top monthly dividend paying stocks. They have over 15,400 commercial real estate properties, and the credit ratings they get for their tenants actually look pretty good. We have to remember a REIT is only as good as the tenants in its portfolio. So even if some of their tenants start to struggle down the road, overall, Realty Income should be fine. Next on our list, we have a stock that's performed really well over the past year, up over 35%, and that is Main Street Capital Corporation. Now, this isn't your typical stock, and no, it's not a real estate investment trust like we just saw with Realty Income. This company is what we know as a business development company. Now, there are similarities with BDCs or business development companies with REITs. What are they? Well, both BDCs and REITs are required by law to pay out 90% of their earnings in the form of dividends. So this turns BDCs into big dividend payers. But the focus for BDCs is to focus on private market investments while REITs focus on income-producing real estate properties. So in the case of Main Street Capital, they provide financing to lower middle market and middle market businesses primarily through debt and equity investments. So if we come down here, we can see they target companies with annual revenue between 10 million and 150 million and annual EBITDA between 3 million and 20 million. Why is this interesting? Well, companies with around 10 million to 150 million in annual EBITDA or even revenue are typically businesses that are too large for bank loans, but they're also too small for large private equity firms. So this is where Main Street Capital comes in. And because these companies have so few options, they're typically willing to pay higher interest rates, which is great news for companies like Main Street Capital. So if we scroll down in this investor's presentation, here's what we can see. The long-term focus is on delivering our shareholders sustainable growth in net asset value and recurring dividends per share. So let's check out those dividend metrics. If we jump back over to the stock screener, come up here and plug in Main. What we can see is Main Street Capital has a really nice starting dividend yield close to around 6.73%. So we're talking about a very high starting dividend yield. And in fact, let's go ahead and look at the dividend history. If we come up here and plug in Main, what we can see is they grow those dividend payments consistently over time and actually pretty frequently pay out special dividends. And if we jump back over to that investor's presentation, we can see Main has never decreased its monthly dividend rate. So in fact, if we look at their dividend breakdown, what we can see is these gray lines right here. Those are the monthly dividend payments that they're making. And then the green on top of it is the supplemental dividends they're paying out. Now, why would they pay out supplemental dividends? Well, we have to remember, the income this company brings in is going to vary based on a few different factors. But the main source of income is going to be their net interest income. And this is also going to be their primary driver of paying out special dividends. Many of the loans that Main gives out have floating interest rates. So when interest rates go higher, they collect more net interest income. And when they go lower, they collect less income. So for example, look right here. During the COVID pandemic, we can see there weren't really many special dividends paid out because net interest income collected was so low. But because interest rates have been so high over the last couple of years, they're making massive dividend payments. So when you understand how this company operates, how it generates income, you're going to have a better understanding of when they're able to pay out those special dividends. But regardless, even without the special dividends, they have a great history of paying out and growing dividends on a monthly basis. Now, one of the things that I do want to point out with Main is if we come down here and look at shares outstanding, we can see you are being diluted as a shareholder. But this is actually pretty typical for business development companies and also real estate investment trusts. Because they have to pay out 90% of their earnings in the form of dividends, they have two different ways that they can raise capital. One, that's going to be taking on new debt, and